Hello everyone. Before I begin, let me ask you a simple question. Why do most investors fail in the stock market even when they have access to the same information? Is it lack of knowledge or something deeper? According to Value Investing and Behavioral Finance by Parag Parikh sir, the real reason lies in human behavior, our emotions, biases, and inability to think long term. My name is Harshil, and in today's presentation, me and my colleagues will be briefly explaining how psychology influences investing decisions and how understanding this can give us a powerful edge in the markets. Next slide, please. Let me begin with a simple question. Why do most people fail in investing despite having access to information? According to Parag Parikh sir, the answer lies not in the lack of knowledge, but in human behavior. This slide focuses on success and failure, and the central idea is very powerful. People fail primarily because they are unable to delay gratification. In simple terms, we prefer short term comfort over long term benefit. We choose what is easy, quick, and emotionally satisfying instead of what is difficult but rewarding. This is called the expectancy factor or the E factor. It explains why students cram before exams, why people avoid discipline, and most importantly, why investors chase quick profits. The author then explains six core traits of human nature. We are naturally lazy, meaning we prefer easy paths. We are greedy, always wanting maximum returns with minimum effort. We are ambitious, constantly trying to improve our situation. We are selfish, driven by our own interest. We are ignorant because we always operate with incomplete information. And finally, we are vain, meaning our ego often influences our decisions. These traits shape how we behave in financial markets. In addition to this, humans strive for six things in life: security, comfort, leisure, people, love, respect, and fulfillment. Because of this, we often make decisions that feel good in the short term but harm us in the long term. So, what is the solution? The key to success, according to the book, is self discipline, doing what is necessary when you don't feel like doing it. This is especially important in investing. The author introduces the law of the farm. You cannot sow seeds today and expect crops tomorrow. Wealth creation takes time, patience, and consistency. Another crucial concept is the importance of emotional quotient or the EQ. In investing, managing emotions is more important than intelligence. Even highly intelligent investors fail if they cannot control fear, greed, and impatience. Next slide, please. This slide focuses on understanding behavioral trends in the markets. One of the biggest misconceptions investors have is that equities are risky. These beliefs come from price volatility. However, the book clearly shows that over the long term, equities outperform fixed income instruments. So the real issue is not the risk, but investors' behavior. The author explains that equity returns come from two sources. First, fundamental returns, which includes earnings growth and dividends. Second, speculative return, which comes from changes in valuation, especially the price to earnings ratio. This leads to a very important insight. Even if a company performs well, you your returns can vary significantly depending on the price you pay. For example, if the market becomes optimistic, the P ratio expands and the and returns increase. But if segment turns negative, the P contracts and returns can become negative, even if the company is doing well. This proves that market sentiment plays a huge role. To support this, the book analyzes the Sensex. It shows that large portion of the market returns is driven not by fundamentals but by speculative re-rating. In simple words, markets swing between greed and fear. Next slide, please. The author then compares two types of investors. Most people follow the physically difficult path. They constantly track news, analyze reports, and react to market movements. Despite all this effort, they achieve average or poor results. On the other hand, successful investors follow the emotionally difficult path. They ignore noise, resist herd behavior, and stay patient. This requires strong emotional control, but it leads to superior returns. Finally, the book defines the stance of a true value investor. A speculator buys when the market is optimistic and prices are high. A value investor does the opposite. They wait patiently and buy during pessimism when prices are low. This creates a powerful advantage. They benefit not only from the company's growth, but also from future improvement in the market sentiment. This combination is what drives superior long term returns. The biggest takeaway from this chapter is that Investing success is less about intelligence and more about behavior. Markets are driven by human emotions, and those who can control their emotions gain a significant edge. Value investing is not just a financial strategy, it is a test of patience, discipline, and psychological strength. Thank you.
Moving on to the next slide. Hello everyone, my name is Anushya Agarwal, and when we talk about growth and value investing, they are often represented as two completely opposite strategies, two opposite ends of the same spectrum. But in reality, that distinction is not that simple. Investors, whenever they try either of these strategies, can make mistakes, and as a result, their returns can get impacted. Such as in value investing, one of the most common errors is equating low value ratios with opportunity. Investors see a low price to earnings ratio or a low price to book value ratio and immediately assume that the stock is cheap and hence a good investment. But that's not always true. Sometimes the market is pricing in genuine issues such as these issues being poor returns or weak growth or structural problems in the business. Ignoring these factors can lead to what we call as value traps, where something looks cheap but continues to underperform in the long run. On the other hand, growth investing is often influenced heavily by behavioral biases. Investors have a tendency to extrapolate the recent good performances of companies and base their future projections on these recent performances. This is where recency bias comes in. There's also the tendency to associate high growth with high quality automatically, which isn't always justified. And when many investors start chasing the same stock, herd mentality comes in, which can lead to overpricing of certain stocks. So, in both cases, we see that the strategy in itself is not the issue, but it is how it is applied. Value investors can focus too much on prices and can ignore quality altogether, whereas growth investors might focus too much on story, ignoring valuations in totality. The key takeaway here is that returns don't come from simply picking either of these strategies. They come from the gap between what the market expects and how the company eventually performs. A good company can be a bad investment if expectations are too high, and an average company can deliver good results if the expectations are low and the company improves over time. Moving on to the next slide. This also paves way for contrarian investing and its concept. A contrarian investor essentially goes against the prevailing market sentiment. This is because they believe that when everyone agrees on something, it gets reflected in the share prices of the stock of the company, and then a mispricing can occur. However, this approach is not very easy to follow psychologically. Investors have to stand firm on their opinions and go against the general opinion. Investors can also get influenced by herd mentality, loss aversion, and the need to look right at all times. And because of all of these behavioral traits, even when good opportunities exist, most investors may be hesitant to act on such opportunities. Over time, though, evidence shows that disciplined contrarian strategies can outperform. This is because they avoid overpaying in times of during periods of optimism and are willing to pay even during a negative sentiment as long as the fundamentals of the company remain intact. Uh, Moving on to the next slide, a good example of this approach is VST Industries. Now, this industry operates in the tobacco industry and has a market share of 10%, but it faces a lot of negative criticism and negative sentiments from the investors because it operates in an industry that is overly regulated by the government, has high excise duties, and also because of ethical considerations. Because of this, many investors avoid the sector altogether. However, when we look at the business itself, it tells a different story. The company has strong cash reserves, gives out high ROCs, has good dividend payout ratios, and no debt on its balance sheet. Despite all of its Despite all of these positives, the company was trading at a substantial discount to its intrinsic value. Why, you ask? This disconnect exists because investors were focusing more on the negative aspect of the industry rather than focusing on the fundamentals of the company in itself. A contrarian investor would be able to spot this gap between perception and reality and see it as an opportunity. So, overall, the contrarian approach reinforces the same idea that we discussed earlier, that markets are driven not just by fundamentals but by behavior. which ultimately gets reflected in the market price. And understanding this behavior and how it impacts the market prices can give a real edge to investors. Thank you. Over to you, Moksha.
Hello, my name is Mokshal Shah, and I am going to talk about how investors often make mistakes by chasing growth and how opportunities actually lie is ignored sectors like commodities. This slide explains an important concept called the growth trap. In the stock market, most investors believe that the high growth companies will automatically generate high returns. However, the book clearly shows that this assumption is misleading. When a company shows strong growth, investors become very optimistic and start buying the stock aggressively. This increases demand and pushes the price much higher than its intrinsic value. At that stage, the stock becomes overvalued and all future growth is already priced in. So even if the company continues to grow, investors may not earn good returns because they entered at a very high price. For example, companies like IRCTC, Zomato, and Paytm had a very strong growth narratives, but many investors who entered during peak hype did not achieve expected returns. This happens because investors are influenced by behavioral biases like herd mentality and overconfidence. They chase popular stocks without focusing on valuation. The key takeaway is that a good business does not always mean a good investment. Price plays a critical role. So, the growth trap occurs when investors overpay for growth due to hype, leading to lower returns in the long run. Moving on to the next slide. This slide focuses on commodity investing, which works very differently from traditional investing. Commodity businesses such as steel, aluminium, or sugar are cyclical in nature. Their profits depend on demand and supply rather than consistent growth. During down cycles, when commodity prices are low, these companies perform poorly and investors tend to avoid them. However, this is actually the best time to invest. As the cycle progresses, lower prices lead to reduced supply. Eventually, demand improves, price start rising, and company profits increases significantly. This results in strong stock performance. For example, Tata Steel and Hindalco, they delivered strong returns when the commodity cycle turned positive after a period of low prices and negative sentiment. This approach is completely opposite to what most investors do. Typically, investors buy when profits are high and sentiment is positive, but by then the opportunity is already gone. The book suggests a contrarian approach, buying when the outlook is worse and selling when it becomes favorable. So, in commodity investing, understanding cycles and timing is more important than just analyzing business quality. Moving on to the next slide. In this slide, let's understand commodity investing through a simple cycle. Just think about this for a second. Would you invest in a company when it's struggling and making low profits? Most people wouldn't. And that's exactly where the opportunity lies. The cycle usually begins with the low prices, where companies are under pressure and sentiment is negative. At this point, investors typically avoid these stocks. Then, what happens is companies start cutting production, supply reduces, and slowly demand begins to recover. As demand improves, prices start rising, profits increase, and eventually we see a strong stock rally. Now, here's the interesting part. The maximum profit is actually made before this improvement becomes visible, which means the real opportunity exists when things look bad. But if we look at typical investor behavior, most people do the opposite. They feel comfortable buying when profits are high and everything looks positive, and then panic and sell when losses appear. So effectively, they end up buying high and selling low. On the other hand, smart investors think differently. They are willing to enter when earnings are low and sentiment is negative, and they exit when optimism is high and everything looks perfect. So the key idea here is in commodity investing, the best results often comes from doing what feels uncomfortable and going against common thinking. Thank you.
Thank you, Mokshil. Hello, everyone. This is Kunal Modi, and today I want to ask you a simple question. Have you ever really understood the investor mindset when it comes to public sector undertakings? In investing, we often chase what is shiny and new while ignoring the giants standing in front of us. We look at the Indian public sector. Most investors dismiss these companies as slow and inefficient simply because they are government run. However, the numbers tell a very different story. Public sector companies contribute around 43% of total net sales of ET 500. Seven of the top 10 largest companies in India belong to this sector. Despite limited attention, these firms generate nearly 37% of total net profit of the top 500 companies. These are not just large companies, they form the backbone of our economy. So why does the market still undervalue them? This mispricing is largely driven by the market perception. The first concern is political interference, where investors believe government priorities may override the shareholder interests. The second is the growth perception bias, where PSUs are automatically labeled as low growth companies. The third factor is the cyclical nature of their businesses. Since many operate in sectors like oil, gas, metal, and banking, however, when we look at the companies such as NTPC, GAIL, SAIL, and SBI, we see consistent operational efficiency and profit margins that are comparable to the private sector peers. The valuation gap exists not because of weak performance, but because of the market prices in uncertainty instead of the actual financial strength. For the investors, this creates an opportunity to buy large profitable businesses at discounted valuations with a built-in margin of the safety. On the other side of the market, we see the growing attraction towards the sector-based investing. Markets move in cycles and different sectors dominate attention at different times. Investors are naturally drawn to emerging sectors because they promise high growth. However, high growth in a sector does not always translate into strong investor returns. Rapid growth often attracts excessive capital, leading to a situation where too much money chases too few quality opportunities. This leads to behavioral biases like re- representativeness, causes the investors to assume that a company's future will mirror the growth of its sector, leading to the overvaluation. The availability heuristic makes investor rely heavily on positive news and media coverage. At the same time, the winner's curse pushes companies to overpay for expansion in order to sustain the growth. At the market level, these biases shape pricing. In the high growth sectors, confirmation bias leads to investors to focus only on the positive signals, while herd mentality drives them to follow the crowd despite stretched valuations. In contrast, in the PSU space, anchoring bias keeps investors stuck in the outdated perceptions, preventing them from recognizing the improvements and value. As a result, capital continues to flow away from stable, profitable companies into expensive and growth driven sectors. Thank you, and over to Vanshika.
I am Vanchika Tibreval, and today I'm going to start off with the fundamental question: whose interest does an IPO really serve? The answer lies in this ecosystem. The promoter wants the highest exit price, and the investment banker earns a certain percentage of the issue size. Thus, they are both incentivized to price it as high as possible. The institutional investors get preferential allotment and early access, whereas the retail investors only get full allotment in those IPOs nobody else wants. Thus, money flows up and the risk flows down. The data is brutal. Parikh sir studied 1,540 IPOs that survived between 1991 and 2000. Remember that 50% of the total had already disappeared and vanished. From the ones that survived, 56% gave negative long term annual returns, and only 15% outperformed the Sensex. In addition, 90% of the IT sector IPOs that were listed in the dot-com era disappeared. Yet, there is immense appetite for IPO. Why? Because of the deeply ingrained psychological traps. First, base rate neglect. We ignore the dismal historical odds. Second, recency and herding. If everyone around us is applying, it feels irrational not to. Third, anchoring. We treat issue price as some sort of floor when actually is the ceiling that the promoter chose. Fourth, round trip policy. We hold on to sinking IPOs paralyzed by the illusion that it is guaranteed to bounce back to the purchase price. Fifth, representative heuristics. A hot sector makes all the IPO in it look attractive. And lastly, underpricing heuristic. The listing day pop is not a gift, it's marketing done to keep the mechanism running. The key insight is that IPO is a product of bull market. The promoter chose to sell it at this price because they thought that it's the best deal for them and not for you. Moving on to the next slide. This slide takes the contrarian thinking further into index investing itself. The conventional wisdom says buy the index, it's safe, it's diversified, it captures creative destruction. But Parikh sir asks a deeper question. How does the stock enter the index? The answer, the 75% weight goes to market cap, 25% goes to liquidity, and exactly 0% goes to business quality. So when you're buying the index, you're actually buying the stock at peak popularity when the valuations are stretched. Parikh sir's research on the Sensex is striking. He tracked every replacement between 1979 to 2005, which was 42 in total. He invested a hypothetical rupees 10,000 in every outgoing and incoming stock that on the date of replacement. The laggard portfolio, which was the stocks removed from the index, grew to 78.9 lakhs, whereas the replaced portfolio, which was the new entrance to the index, grew to just 31.7 lakhs. That's a 2.5x difference in doing exactly opposite of what the index tells you to do. The Nifty showed the same pattern. The laggards outperformed in 22 out of the 35 cases, which is a 63% win rate. Look at the marquee cases. The ones on the left are the ones that got replaced and have outperformed the ones that replaced them. When a stock enters the index, the passive funds are forced to buy it at an inflated price. And when it gets removed from the index, they're forced to sell it at a depressed price. Thus, index systematically buys high and sells low. Next slide. So what do we do with all of this? On the left, there's the Hertz playbook, buying IPOs in bull runs, trusting the conflicted research, equating market cap with quality, and finding comfort in the crowd. And on the right is the contrarian's playbook. There, we skip the IPO frenzy altogether, wait for the post IPO crashes. So, in buying post IPO crash to buy the same company cheaper, and buying stocks once they are removed from the index because forced selling creates genuine value, and having the conviction to stand apart. The unifying principle across both these slides is simple. The price you pay determines your returns. The IPOs are priced for the seller's benefit, and index additions are priced at peak sentiment. In both cases, the crowd overpays and the patient contrarian is rewarded. Parikh sir puts it best. It's like taking the road less traveled. It takes years of perseverance before you realize it made all the difference. Thank you.
Hi, this is Jia Jariwala, and I'll be talking about market euphoria and valuation risk, which is nothing but a bubble trap. A bubble trap is a situation where investor gets stuck believing something that isn't realistic. Price rise rapidly, not because of real value, but due to excessive optimism and confidence. Let's now quickly look at how bubbles are formed. It starts with displacement when something new, like technology or policy, creates excitement. Then comes the boom phase where price rise quickly and more people start investing, often using borrowed money. Next is the euphoria where investors act irrationally and believe prices will keep rising forever. After that, the smart money exits. Experienced investors start selling and starts taking profits. Finally, Panic sets in, prices crash, and most investors are left with losses. There are some key signs to identify a bubble. First one is high P ratio, where stock price reflects unrealistic growth expectations. Second, the overpriced stocks or commodities, where prices rise far above their actual value due to hype. Third is the media hype, which spreads only positive narratives and encourages herd behavior. Lastly, when lesser known companies suddenly gain attention or enter major indices without strong fundamental, it's often driven by excitement and not the real value. Next slide, please. Let's see what lessons investors should learn out of this. First is avoid extremely high P ratio, as they are just reflecting unrealistic expectations. Secondly, be cautious with mid cap and small cap stocks, since they rise quickly during the high but can fall just as fast. Third, watch out for representative bias, where you assume current success will continue just because it has in the past. Fourth, don't rely on size alone. Large but lesser known firms may still lack strong fundamentals. Fifth, understand information asymmetry. Sometimes insiders or experienced investors have better information than retail investors. Sixth, be careful of the mindset that this time is different, because history shows bubbles repeat. Seventh, always follow a structural decision making process instead of just acting on emotions or market noise. And finally, avoid short selling due to bubbles, because market can stay irrational longer than expected. By keeping these lessons in mind, investors can protect themselves from heavy losses. Next slide. Let's look at the impact of stock prices on the company. A strong stock price builds investors' confidence. It helps company raise funds easily, attract talent, secure better deals, and create a positive future outlook. On the other hand, a low stock price signals lack of confidence. It makes it harder to raise funds, attract employees, or secure loans, and even increase takeover risk. Now, coming to the roles of investors, investor plays an important role in determining company's success or failure. Traditionally, company follow an efficient market approach, focusing mainly on operations like employees, customers, and suppliers, but they often ignore investors' behavior. What companies should adopt is a behavioral financial approach, where they also study their investors. This leads to a paradigm shift, which is researching on investor behavior. Companies should focus on profiling investors, which is understanding whether they are long term, medium term, or short term focused, and what factors do they analyze. Second is mapping of investors, where companies should understand what information they use and how they make their decisions. By doing this, company can communicate better, manage expectations, and build stronger relationship with their investors. Now, concluding the whole presentation, I would like to say that markets are driven as much by human emotions and biases as by fundamentals. Most investors lose money because of their psychological mistakes like herd behavior, overconfidence, and fear greed cycle. Value investing works by buying undervalued assets which with patience and discipline, ignoring all the market noise. Here, successful investor thinks independently and often go against the crowd, which is the contrarian mindset. Last but not the least, long-term wealth is built by controlling behavior more than by predicting markets. Thank you.